So, guys, welcome along to this mentorship session. Just to confirm, everyone can see the screen, okay? Everyone can hear me, okay? I'm assuming. Um, Today is Wednesday, the 5th of July. Just a heads up, guys, if I do cut out, typically I kind of get bad internet at this time of night. I don't really know why. If I do cut out, I will send a link. I'll jump on the iPad and I'll send a new link on the Discord. So don't panic if I get cut out in the next sort of, half hour, whatever. So, guys, what I want to talk about today is, and as mentioned in the announcements tab, is your bias, something which is called Power of Three, which you may or may not have heard of, and actual entries, and kind of combining the lot of them to give us really, really good entries. Now, I don't know how seriously you guys take the higher time frames. I really don't know if you're just kind of shopping around on 1 hour timeframes and 15-minute timeframes and 5 minute timeframes, and you're not actually taking into consideration what's going on a lot higher. And in all honesty, if you're not, that's something you need to start doing urgently. Okay, it's very, very important to look at where you want price to go each and every single week, because that is going to give you overall bias, and overall bias is going to give you a better setup if you're trading in direction with the higher time frames. Yes, you can take counter trend trades. If anyone here remembers or has done the course recently, I've spoken before about market structure. I can't remember what module it was in, but I spoke about how basically this is how the time frames end up working. So on a smaller time frame, you can be buying, you can be selling just like this, you can be buying, then you can be selling again just like this, and that there would obviously represent a different time frame. So if this green area here is your daily time frame or your 4 hour time frame, then the red lines here can be maybe the 1 hour or 15 minute or something like that. And this is market structure as a whole. This is how to identify price that moves in certain ways. And where we are looking at these areas here, you can be a buyer in this area here, but you have to understand why you're a buyer there and why you want to get out here. You can be a seller in this area here, and you can be a seller in this area here. But you have to understand why are you selling there and why are you getting out here. And then when you see price move higher again, you can be a buyer in this marketplace here, but understand why are you only getting out at the next high, or why are you getting out at 50% of the daily time frames, for example, or 50% of the higher market range. So there's an abundance of opportunities that you can be taking. However, when you identify the best place to be taking a buy or a sell in a market which is clearly bearish overall a daily time frame, to get sells or buys or get trade that are really going to give you your funded accounts and put you in the 6, 7 figure bracket of traders, you need to be trading in line with the higher time frames. So yes, you can get in on moves here, but it's all temporary. You need to be looking to trade when price comes up to a point of interest on a daily time frame, or a higher time frame at the very least. And then you can sell all the way down to the next low on the daily. So you can be taking advantage of price action coming all the way down. Yes, on smaller time frames, again, you can definitely be selling as long as price hasn't yet taken out this high. So on a smaller time frame, you can do what we call continuation trading. Now, once we get continuation trading into it here, you can absolutely do it. There's nothing stopping that at all. But you have to understand, once you've hit this low, you are out of the trade essentially. And then when you see price come back into this point of interest area here, you can be a seller once again, and you're going to be targeting these areas right here. And this is all going to make perfect sense for you guys at the end. And we're going to talk about entries and things like that. And hopefully by the end of it, any of this confusion that you find is going to be answered. Okay. So long story short, yes, it's very important to go with the higher time frames. Now, when I look at what price is doing over here, okay, we can see that we're clearly pushing to the upside. So what do we anticipate this trading week is going to be? Now, I know we're halfway through this week, and this week's been next to nothing in terms of trades. That's simply because of the US bank holidays that have been going on. So today really is the Monday for trading. I'm still expecting price to push higher. It might not be a bullish week like the one we just had, but overall, my target for this area here is here. Now, the only reason I've come to that target, it's very, very simple, and this should never be overcomplicated. The reason this is a target for this week and next week, to be fair, or until it even happens, is because A, we're bullish, and B, when I look to the left, what is actually the next target available to me? What is the next area of liquidity available to me? It is literally this area right here. There's no imbalance. There's no equal highs. This is the next high on the weekly time frame. That's the target. That's where I'm looking. That's where I want to see price go. Now I can bring that down to a daily time frame. I can have a little look and see what's here. And what can I see? I can see imbalance. I can see that. So if I wanted to bring that all the way across, I can. I can obviously see that we're inside there. We are still pushing higher. Now we're pushing higher than this area here. We are inside. Again, if we look, we've got another institutional candle here. You can see that where price is at the moment, we are pushing higher. So that gives me more confidence that the daily time frame is bullish, and I am aiming overall for this high here. So that's my next target for US 500. And likewise on NAS, it was here with these equal highs. We've just about managed to get past them. In fact, what we're doing is creating a bit of a triple top. So this is only going to entice a lot of sellers into the market. I wouldn't be surprised to see price go higher. Now, if price is going to go higher, bear in mind we want US 500 to go higher. I can look to the left. Okay, yes, I can see these areas. This will be taken very, very quickly. What else is there? Well, we've got this unmitigated institutional candle right here. So that is my target for the week. That's where I want to see price go. Now, it's not necessarily going to happen on that day, but where is it going to go? Now, when I talk to you about power of three, I want you to envisage what a candle actually is. Okay, so we know a candle consists of this bar right here. And we know here that the candle has wicks, and this is essentially where price opens. So if this is a bullish area, we know that price opened here. We know that price closed here. We know that price traveled down to this area on its bearish part, and then when it was bullish, it traveled up to this area here and then retraced down to close for the day or the trading hours that we're actually in. But the actual historic thing, and now the power of three concept comes from a person called Larry Williams. Whether you've heard of him or not, I don't know. He's probably one of the most famous traders out there. He was able to turn something like £1,000 into £1 million, and then £1 million into something like 500 million just through trading using the power of three. And whoever else is sitting there saying they create the power of three, they did not. This guy created it, and he's got books on it and things like that. So I definitely recommend looking up that guy, Larry Williams. Now, the original power of three came from certain types of candles. Now, we can absolutely use these candles, but this is just a better way to kind of explain the way the power of three works by using these candles here. And when you actually use these candles, when you go into the candles area here, you can change these candles to certain things. Now, you can see here, if you change it, it doesn't look as attractive. It doesn't look as good. But what we can see is, the same thing, which I'm kind of showing you here. Now, let me just turn that back because that's definitely hurting my eyes. What we're looking at here, guys, is the open, which is right here. Okay, so we know that price opens here. We are looking at the close. We know the close here. But what we're looking for is, in a bullish day, what we are wanting price to do. Now, we want to be buying price at the lowest point possible in this candle. And we want to be selling price in the highest point of the candle if you're overall bearish. Now, if another trading day has happened or happening as we speak, so let's say the trading day opens here, because the close of this area happened at this area here, we know that the next candle has to open right here. Now, typically what you end up getting, you don't usually get a candle in a bullish day that looks like that. I'm just going to pretend we've hit that target. Very, very rarely will you get a candle that will look anything like this. It will always have some form of move to the downside. It will have some sort of move to the upside, and then it will eventually drop down to a lower point. What you need to use these areas for is on a daily time frame, you identify where you think price should go if you're bullish. Now, if you're bullish, we know this is the target. We're using a daily time frame. Now, when price actually opens, we know that we're expecting price to come down, manipulate the markets, mitigate into some areas that are sitting within here, and then eventually from this area down here, because what will happen is you'll get into London session, New York session, price will be doing that. And what you'll see on here is a bearish day. If you go onto the daily time frame, it will be very, very bearish. You won't see anything that would make you think, oh, this is bullish. This is why trust in your instinct, trust in your bias is so important. And most of all, being patient is the most important thing in the world. Because overall, a daily time frame, you can be bullish, but you could be waiting, and it could look on a 15-minute time frame, on an hourly time frame, it could look extremely bearish. But when price gets into your area down here, you are trusting to find a setup that will actually take you higher to reach your targets. Now, the easy question to ask here is, what if I'm wrong? What if actually price opens here and does something like that and pushes, higher in the Asian session, and then ends up maybe just closing below this area here with manipulation? Because yes, there is going to be liquidity here. Well, if that happens, here's the thing. You're not going to be taking any trades because you probably won't see many buy models. You'll just see price push down. In which case, very unlikely you're going to be having a trading day that day. Now, worst case is you take a trade because you're looking desperately for accumulation, and you don't see it. You see maybe a half-assed attempt of accumulation, and it's not really ideal, but you see it at a certain time that you want to trade, and you just take it for the sake of taking it, and it's not really in a positive area or anything like that. You end up getting into a situation where you're forcing yourself into a trade and you lose. If that's the worst case scenario, that's fine. As long as you then identify from a daily point of view, overall, you are more or less getting it right more than you are getting it wrong. But if you are bullish on this market here, you need to be aiming to be buying below the open. If you buy below the open, you're in a heavy discount area. If price is, and I'm going to just do this down here, if price is bearish for the day, you want to be selling above the open because you are in a premium area. And that is what you're looking to do. When you're using these candles, they are very, very important, especially when looking for what you want your daily bias to be. Now, that is as simple as the power trade. We're going to do some really cool examples about, on the charts and things like that. But if you're looking for accumulation in a bullish day, long story short, you need to be buying as low as possible, or at least if price is around the open. And it might be that price has dropped a little bit lower and started accumulating in here somewhere, and it may be accumulated in a certain area, and by the point in which you got to the charts, you've maybe missed it, but you can see another area of accumulation in here to go higher. And what's important with the power of three in this area here is that when you buy, you want it to go obviously above your opening price. Now, when price is going above, you need to be thinking to yourself, where is this actually going? Okay, this is when you look to the left and you identify liquidity. So on on the daily time frame, on your 4-hour time frame, on your 1-hour time frame, what you'll see is ranges and markets and liquidity. And you have to be looking to the left. Just look to the left and identify your closest range of liquidity. And that has to be your target. It's as simple as that. Even if you're only getting 5 pips out of the market every day, if you're getting 0.5%, because you're only risking 0.5%, you're getting a 1-to-1 trade, or you're getting 1% a day. A percent a day is 5%.